wonder how a state evaluates the sales tax liability of a remote seller it's never met? Well, in 2026, it's not luck, it's algorithms, cross-referencing your marketplace reports, 1099-Ks, and filings in seconds. We've defended sales tax audits for 25 years, and the rules of getting caught just changed. First, let's talk about how a state spots a business it has no obvious connection to. For years, audit selection was part random, part hunch. That's over. State revenue departments now use machine learning, software that scans huge volumes of data looking for patterns, to read every filing that comes in. And they're not just reading your returns, they pull your 1099-Ks, the forms that payment processors and marketplaces send the state reporting your gross sales, plus the sales reports that Amazon, eBay, Etsy, and Shopify file directly. They then cross-reference all of it. If your numbers don't line up across those sources, you get flagged. The point is that you're not hiding in a pile of paper any longer. Second, and this is the part worth sitting up for, states are now openly building AI into enforcement. South Carolina's Department of Revenue confirmed it's starting to use AI to help choose which returns to audit in 2026, and it's joining a growing list of states moving in the same direction. The IRS formalized its own AI-assisted audit selection in internal guidance this February, and now runs well over 100 AI use cases, roughly double what it had 2 years ago. Here's the reframe most people miss. Getting flagged by an algorithm doesn't mean you're accused of fraud. The software is spotting a pattern that deviates. That's all. But deviation still lands you in a review, which is exactly why the details of what trips the wire matter. Third, let's get specific about what causes a mismatch. Say your eBay 1099-K reports $200,000 in sales, but your sales tax return shows $50,000 in gross receipts. To a human, that gets tossed into the "we'll get to it" pile. To an algorithm, that gap is obvious in seconds. Multiple marketplace accounts whose combined revenue doesn't match your filings will do it too. And more states are pushing sellers from quarterly to monthly filing, which hands an auditor 12 data points a year to compare instead of 4. On top of that, the underlying rules keep shifting. Illinois, for example, dropped its 200 transaction nexus trigger on January 1st of 2026. So the threshold that used to apply to you may not anymore. Which brings us to the only question that actually helps you. What do you do about this? Here's the takeaway you can act on today. Reconcile your own numbers before the state does it for you. Pull your 1099-Ks and marketplace reports. Line them up against what you actually filed and explain any gap before a notice arrives. Most mismatches have a perfectly good reason, like returns, refunds, or marketplace collected tax. Make sure you're registered in every state where you've crossed the nexus threshold, and keep your resale and exemption certificates valid and on file. AI can flag a missing certificate instantly. It can't invent one for you. The businesses that sleep fine in 2026 aren't the ones hoping to stay invisible. They're the ones whose numbers already match. But getting flagged is one thing. Knowing the changes that are actively happening before you get flagged is another. And for more information on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.